Hi everyone, and welcome to my new video series where I conduct real experiments with various trading strategies. And today I'll be discussing funding rate arbitrage strategy. I played with it for about 2 months and I enjoyed this a lot. During this time I did some coding, I got new knowledge and had several insights. And in this video, I'll break down the funding rate arbitrage strategy. I share the script I made for searching funding rate opportunities and reveal the results of my trading. And remember, this all based on my personal experience and is not intended as financial advice. First, I'll give a brief explanation of funding rates. If you're already familiar, feel free to skip ahead. And futures markets, operate differently from spot markets, and instead of trading the actual asset, futures involve opening positions that in the end you need to close and get a profit or loss. And when you buy, it's called taking a long position, and selling is taking a short position. And while prices in futures markets correlate with the spot markets of the same asset, they can also diverge significantly. And let's first consider delivery futures. They called like that because there is a delivery date, and on that day, all open positions are closed using the actual spot price. And as the delivery date approaches, the futures price tends to converge with the spot price. But in the crypto world, there are also perpetual contracts, and they don't have a delivery date. Instead of expiration, there is another mechanism to keep the prices of perpetual markets close to spot, and it's called the funding rate. And the funding rate just periodic payments between long and short positions. And when the price of the perpetual contracts diverge from the spot price, those who push the price further away from the spot will be punished, while those who bring it closer will be rewarded. And for example, when the price is higher, longs will pay the funding rate to shorts because they are driving the price even higher. And in this period, funding rate is positive. And in the opposite scenario, when the price is lower, shorts will pay longs. And here in this period, funding rate is negative. And these payments occur periodically. For example, if the funding period is set at 8 hours, funding will be exchanged 3 times per day. And let's take a look at the perpetual market. Here you'll notice a funding rate and a countdown to settlement. And the rate is positive, meaning that if you have an open short position, you'll earn a profit of 0.01 of the size of your position every 8 hours. And if this rate remains stable for a year and you maintain your position, you will gain 0.03% per day, and that's approximately 11% annually just by holding the position. However, it's not simple like that. Both the price and the rates fluctuate, and in the funding rate arbitrage strategy, the goal is to collect the funding rate while mitigating the impact of price movements. And to achieve this, it's necessary to open the opposite trade on another exchange, so hedging against the price volatility. And to make it possible, basically there are 2 options. The first one is open a position on perpetuals and hedge it on the spot. And this approach is called spot perpetual funding rate arbitrage. And spot trading doesn't involve any funding, and you only need to pay fees to open the orders. And in this example, the funding is positive, making it relatively easy as you need to buy an asset with USDT. However, when funding is negative, you need to sell the asset on the spot, and that requires borrowing it first. And this adds a bit more complexity, but it's manageable. You can watch my previous video about borrowing for more information. And the advantage of this approach, spot perpetual, it's that it's simple, it's simplicity. You only need to consider one funding rate, and you can use just a single exchange. A second option involves opening 2 positions on 2 different perpetual markets with different rates, and you open a long position where the rate is lower and a short position where the rate is higher, and you collect the difference between these rates, and this strategy is called perpetual arbitrage. And the advantage include lower fees, the ability to use leverage and increase potential profits. Also, I found that it's more flexible. You can have like cross margin on both exchanges. And in case the market moves into some direction a lot, you can transfer funds from the exchange with profits to the one with losses to some degree, of course, and like distribute the capital without closing the positions. And while the second option seems better at first glance, I found that typically spot perpetual has more opportunities than perpetual. And that's because all perpetual markets usually correlate, so it's not very often that the difference between rates is too high. And in the spot markets, there is no funding, so we just need a high or low funding rate to profit. And as for leverage, I found some nice approaches that allow me to use leverage on spot markets as well, and I'll explain it in a minute. And we are gradually moving towards the methods I used and the results. It's important to note first that in my experiments, I focused on a long-term strategy. So if you open orders and close them right after you've got the funding, it's a short-term strategy, and you need very high rates to make a profit because of the fees. But I only tested a long-term strategy, holding position for weeks to accumulate funding and minimize fee impact. And first, I want to explain different approaches I used in asset allocation. And imagine I have $1,000 and I will use dollars instead of USDT for simplicity. And if I choose the spot perpetual option and divide my capital equally, like 500 to spot and 500 to perpetual, I don't use any leverage, and with 0.2 rate, I make a $1 profit. And next, if I do the same with perpetual, and again divide the capital equally, but now I can use 3x leverage and can increase my order size 3 times. Of course, there is more risk involved, but now I can increase the profit to $1.5. And now let's try to use leverage on spot as well. And to achieve that, I have 2 options. The first one, I can distribute the capital unevenly and allocate, let's say, 75% of my capital to spot and 25% to perpetuals. And next, I will use 3x leverage on perpetuals, resulting in an increased order size compared to the first option, and so the profits and the risk as well are increased, and I got, like here, 1.5 profit again. And the last option I experimented with, which I found most interesting, was using spot margin instead of spot. If you've never tried margin spot before, you've probably noticed these like 3x, 5x, or 10x numbers next to trading pairs on exchanges. And this involves trading on spot while using leverage. It can be done by opening a trade and simultaneously borrowing the assets needed if you don't have enough. And this approach allows me to evenly distribute my capital once again and have leverage on both types of trades. But while there is no funding on margin spot trading, instead there is a lending rate that is also volatile, and it must be taken into account. And based on my experience, this rate is typically lower than the funding rate, at least on the Gate.io exchange that I used for trading. And also because I'm borrowing just $1,000 here, even if it's the same as funding as I wrote here, it's equal to 0.1%, I found this option usually like going to give better performance. And first, I met the strategy on the CoinGlass website, and let's look at it right now. It shows real-time opportunities for both spot perpetual and perpetual funding rate. And you see here you can also like filter the long and short or choose the exchanges. But the number of exchanges is very low, only 4 is available, and while you can use this tool, it's very limited. So what I did, I created a Python script that does a similar job, but for any exchange available in the C60 library. And I give you a link to GitHub so you can use it as well. And let's see in short how it works. It's user-friendly and configuration is very simple. You define perpetual and spot exchanges here. Then here there is a separate logic for getting data and analyzing it. So first you can just retrieve the data and the script will store it in files and then analyze it. So you can run analysis multiple times on the saved data. And this process is also great because fetching takes lots of time, and in case of any errors in the fetching process, you will not lose all the data because it's saved in files. Or you can even develop your own analysis using these saved files. And what the script does as well, it also gets historical rates for some days that you can define here. So you can see the dynamics of the funding rate and interpolate your API using the historical data, and I will show it in a minute. And I've added a calculation that helps to understand the volatility of the pair. And this is an average and the maximum daily amplitude of the pair price over the number of days defined here. And what is amplitude? Amplitude is percentage difference between the daily high and low prices. And some exchanges display this data. For example, see here, you can see the data for open, high, low, close, change, and amplitude. And while the change is the percentage difference between the open and close prices, the amplitude is the percentage difference between high and low. And you see here, amplitude is always higher than change in absolute values. So it shows the maximum range the price had in that day. And my script calculates the average and maximum amplitude for the specified number of days in the configuration, so I can understand the maximum and average movements of the pair. And now let's take a look at an example of how files generated by the script and how I typically analyze them. I have 3 files, one for perpetual and 2 for spot perpetual opportunities. And one is for negative funding rates and the other for positive ones. And I can analyze these opportunities separately. For negative rates, I need to borrow and set up slightly different approach. And let's look at spot perpetual opportunities first. Here I've opened a file showing positive rates. And you can see here the perpetual pair, the current funding rate, the average API. It's calculated from historical data over the last few days, interpolated on an annual basis. And the number of days for this calculation can be configured. As I showed earlier, here I've used 3. Next, I have the perpetual exchange. And in the case of a positive rate, this is an exchange where you short. And here there is a list of spot exchanges where this pair is traded. And lastly, there is the amplitudes data as described earlier, along with the number of days available for calculating the amplitude. This is either 100 or less if there wasn't enough data. And how do I choose what to trade from that data? I typically start by examining 2 columns, API and maximum daily amplitude. And the API indicates a potential long-term profit, which aligns with my focus on the long term. Typically, the higher the number, the better. However, some may be negative, indicating that despite the current rate being positive, historically the rate was mostly negative. And I usually filter this out using a threshold such as greater than 30%. And after doing that, not many opportunities are left. And what I will do next, I will look at the maximum amplitude and sort it from the smallest to largest, just to prioritize the least volatile pairs. And using this column, I can also understand my potential leverage or decide whether to enter the pair at all. My strategy is to prioritize pairs with amplitudes no greater than 40. Even 30 is preferable as these pairs tend to be more stable. And for pairs with large amplitudes, I will only enter if I observe a very high API. However, I will divide this API by 2 or even more as I will enter without leverage and possibly with a larger margin, enough for price fluctuations. And after this, I see that only 2 opportunities are more or less acceptable with amplitude less than 40. And additionally, I want the spot pair to be available on as many exchanges as possible, meaning that the pair is common and liquid. So here's the one opportunity is great, but this one has great API, so maybe only two here that I could enter, but it isn't many for diversification. So if I decide to enter, I will then investigate how they are traded on the exchanges, identifying the spread and the trading volumes. Next, let's look at the file with negative rates, because there is currently a slight downtrend, and there may be more opportunities available there. And here the structure is the same as in positive, and I will do the same here. I'll filter first by API greater than 30. Next, I will sort from smallest to largest maximum amplitude. And I see some opportunities, but data isn't sufficient, like here. So I'll filter this column as well to include data from around 100 days. So maybe a bit more opportunities than in positive, but still not so many. And like these ones, I potentially consider entering because their amplitude is less than 40. And for this, I need to divide the API by 2 or more. So only this one catches my attention, and I can investigate it later to understand if it's a good market to enter or not. Or I will just observe its funding for the next few days. And from the rest left here, I prefer those with the most number of spot exchanges. So only these ones are great. And maybe also like rare because its API like very high. So if you see, it's only 4 assets. So what I will do next, I will look if these coins are borrowable and their current rates. And for that, I will go to Gate.io and I will enter the first one. For example, AXCS, and yes, it's borrowable with enough liquidity and nice rates. So next, Blur. It also has enough liquidity, but high lending rate. So I need to subtract this from my API, and that's not good. And next, Cyber. Cyber is borrowable, but the rate is very high. So it's not good. And next, like Rare, the final one. Again, it's okay. The liquidity is nice and the rate is also like very low. So I will just remove Cyber from my list. And next, what I can use, I can decide, if I decide to enter any opportunities, I will try to choose like as less exchanges as possible, like to minimize management across many platforms. And if I decided to enter something, I will probably choose like from these opportunities Rare, and it's on Bybit. And we also have Blur on Bybit, but as we remember, Blur is not has a very high lending API, so probably only Rare is left. So probably I may choose not to enter anything and instead wait for a better day and just observe the situation. And next, let's take a quick look at perpetual as well. Probably there's something interesting there. And here you see the data is very similar, but with a few more columns containing data for 2 perpetual exchanges, like short exchange, long exchange, a short rate, long rate, etc. And the rate difference instead of just the rate. And let's apply the same filtering based on API greater than 30. And next, I will sort the amplitude also like before, and remove everything that is less than 100. And from the left opportunities, I've noticed that the API isn't very attractive. And for assets like below 40 threshold, like a few options just remain, and these are the ones I can use with leverage. And what I will consider next, I will try to enter as few exchanges as possible, also like to minimize management. And for example, if I choose to enter this one because the API is like high, So I will also probably enter this one as well. They are opposite, so they will likely compensate each other, which is great. But overall, I don't see many interesting opportunities here, so maybe I will wait again and not enter anything. So that's in short how identify pair using the script. So what could be the next steps? After selecting the pairs, exchanges, and leverages, I just distribute the capital to the accounts on different exchanges and calculate the order amounts based on the leverage and my choosing like asset allocation. And then I open my orders, often using two windows side by side and just open them manually. And once the orders are opened, I set up stop losses and take profits, typically placing them near the liquidation price as a safeguard against sudden market volatility. And additionally, I could set up notifications for reaching specific price levels. And next, I just manage my open positions by monitoring their prices. And my rule of thumb is that if the price moves significantly in any direction and I'm left with only half of my margin or collateral in the case of borrowing, I take actions such as like close the position or redistribute capital. And then I just watch the rates, funding rates, calculate my profit, and run the script again to determine if I need to close any unprofitable positions. And to calculate profits, I have two methods. One is more complex. It's to downloading statements from the exchanges and calculating like all the profits from rates obtained and interest paid for a loan and fees as well. And the easier method is to have all positions and spot orders opened like on separate sub accounts and just like calculate the total value or equity. It's usually shown on the exchange and summarize them on every exchange and subtract the invested capital. And I find both methods to be correct. However, with the second method, it's important to be cautious about understanding like the total displayed, as exchanges may have multiple types, such as only available or with and without liabilities like loans. But once understood, it becomes like an easy thing to do. I experimented for 2 months with this strategy. And returns seem not so high in terms of USDT. But if you look into the API column, you can see that the returns are actually not so bad. And I started with smaller capitals like 500 for each pair and without any leverage, and then gradually increased the capital, leverage, and number of trading pairs. And here I have more than 10 trading pairs, for example, with 3x leverage, and it was quite challenging to manage positions. The markets were very volatile at that moment, and I experienced some liquidations, hit some stop losses, and reopened positions often. Still, I think I got good profits here, but next I decided to go with less leverage and fewer trading pairs involved, so I entered with 2x maximum. And what I found is that a spot margin worked better for me than perpetual or spot perpetual, where there is no leverage at all. It was more profitable to go for a loan than to have another open position on perpetual. And this period was an upside trend for many trading pairs, and funding rates were positive and very high. So maybe that's why the returns were also great. This is the downside of the strategy. The profits are very unstable and dependent on the price fluctuations. Like, for example, here is the plot showing the correlation between BTC price and my API from the last experiment on a daily basis. And, here I was getting profits from shorting. So when the price goes down, my profits also go down. And my final thoughts are that this strategy works, at least for the duration of my experiment, but the returns are very volatile. And next, I think it's better to automate some tasks, because managing many positions manually requires significant effort, and it's more efficient to have a tool that monitors positions, sends alerts, closes positions, calculates profits, and to minimize manual work as much as possible. And I also see other opportunities I haven't experimented with, such as a short-term strategy, where you open and close positions quickly after just getting profit. And while there may be fewer opportunities, this approach could involve less risk and potentially better performance. But I don't know, I need to try to know it to be sure. And summarizing these 2 points above, the automation and short-term strategy, Hummingbot, a tool that I admire and use daily, has recently added the funding rate arbitrage strategy to their code base. And therefore, I believe the short-term strategy could be automated and tested with Hummingbot. And I'll provide all the links for more information about Hummingbot below. And the last, I would also like to thank everyone who reached out to me directly. Sharing ideas and questions gives me new insights, and I hope you find value in our exchange as well. As you know, much information in trading isn't openly available, and you often need to dig for it yourself, so feel free to contact me. You can find my details in the channel description. And that's all for now. Thank you for watching. Have a great day. Enjoy your profits and be happy.